All right, hello everybody. We'll just wait a few more moments as people filter into the webinar. Bear with us. All right, I think we've got most of the people we're waiting on. So welcome to today's webinar, Mythbusting the COVID-19 250 grand Federal Government Unsecured Loan. My name's Sam Wagner. I'm one of the directors here at Perks Accountants. My role forms part of our accounting and business advisory service. It's fair to say we've been kept quite busy over the last 8 weeks with all the stimulus measures being announced, both from a federal and a state level. So our clients have had a varied experiences, ranging from a slight downturn in business to right through to the forced closure of businesses in the retail and hospitality space. Similarly, our role as advisors has also been pretty varied, from advising on how much our clients can expect to receive in stimulus benefits and whether they're eligible, the whole way through to preparing adjusted cash flow forecasts to take into account the effect, both for business owners so they understand where they're going, and for third parties like banks. One of our most common queries at the moment, and probably the reason you're all here today, is how do I access more cash for my business during this uncertain period? But before we get into the presentation, I'd just like to encourage you to use the Q&A function there in Zoom. So Steve Martin is a relationship manager at Perks Finance, and he's standing by to field any queries you have. We'll do our best to ensure we answer them during the presentation, either by returning in that Q&A function, or we may even discuss them. We'll have a bit of a break in the middle and a break at the end to address those queries. So shortly I'll introduce Bruce Debenham, who's the Director of Perks Banking and Finance, who'll take us through the detail of this Federal Government Unsecured Loan. But first, I guess just a bit of a context for those of you who may not be aware of the services they offer. So Perks Banking and Finance is a full service mortgage broking service with exposure in the residential and the commercial lending spaces, and are experts where the two overlap. They deal with all the major lenders, as well as a host of second tier lenders. And in recent years have started doing more and more work with what we refer to as fintech lenders, who are all relatively new to the market and trying to disrupt the bigger banks. Bruce and his team regularly work with us on the accounting side to ensure our clients have got the best banking structure available, but they also service a number of clients that are not necessarily accounting clients of the firm. So you don't need to be an accounting client of the firm to take up Bruce's services. Bruce is a seasoned finance professional with over 30 years of experience in banking, risk management and consulting. He's held senior leadership positions at NAB and Rural Bank, and has worked for two of the big four accounting practices. His experience spans various industries, including property development, manufacturing, agribusiness, healthcare, retail, transport and hospitality. So with no further ado, I'd like to hand over to Bruce.
Excellent. Thanks very much for the introduction, Sam. Good morning, everyone. My name is Bruce Debenham. We do have a number of you online today, so thank you very much for taking the time to attend. As Sam mentioned before, there is a Q&A button, and we do encourage you to use that during the course of the webinar. There will be some time reserved midway through the webinar for you to ask any pressing questions that might come to mind as I'm talking. So without further ado, I'll go on to the presentation itself. So Mythbusting the COVID-19 $250,000 government unsecured loan. Sam will also be on hand to answer any questions that may relate to your business and the services that Sam provides. So how does it work? the government or the Cronus SME Guarantee Scheme has been set up by the federal government to provide $40 billion worth of lending to SME businesses. Under the scheme, the federal government will guarantee 50% of the loans that are provided by the banks, and there are over 30 banks that have signed up for the scheme. The aim of the scheme is to enhance lenders' willingness and ability to provide additional working capital to those businesses that have been impacted by coronavirus. The scheme will be available for new loans from participating lenders for the period from now until the end of September this year. And to be eligible for the scheme, you need to meet certain criteria, which isn't too extensive. Your turnover needs to be less than $50 million. The maximum loan size per borrower, and it's important to note that it's per borrower, is $250,000. The term of the loan is for 3 years, and later on in the webinar, I'll run through with you how that works. And the finance that's provided by the lender is unsecured, which means you don't have to provide your home or any of your business assets as security for the loan. So, the next slide. How will the banks look at this? So, the decision as to whether or not the bank will extend credit is entirely rests with the banks. The government haven't stipulated that the banks must do X, Y, or Z. The banks will use their normal credit criteria in terms of looking at the application. So it's no different to a loan that you may have applied for prior to COVID-19 occurring. However, the government does expect lenders to look through the cycle to sensibly take into account the uncertainty and the current economic environment presents at the moment. And that should assist them in determining whether or not credit can be provided to you. So the purpose of this webinar is really to look into what it is you need to provide to your bank or to your lender to enable them to properly assess your application. The only real difference, I guess, is that the banks really do want to process these as quickly as possible. And some banks, if it's fair to say, are more equipped or better equipped than others at the moment in terms of their setup for this. So the next slide, in terms of your business's performance. So what will you need to explain to the bank, or the lender, sorry, to establish how your business has performed? The first point, I guess, is to really look at your year-on-year comparisons. How is your business looking in this period last year compared to how your business is looking now? So very, very similar to what the government have requested in terms of the parameters for the JobKeeper application. You know, how have you been impacted? Now, JobKeeper, they did stipulate that your turnover had to decrease by 30%. However, that's not a requirement of this particular package. The other question to ask is, were you operating within your facilities and the facility limits and the terms of the facilities that were provided by your lender prior to coming into COVID? So if you were, that's obviously a positive. If you were experiencing some problems beforehand with your lender, they will take that into account. Another thing to look at is what does a normal or a sustainable year look like for your business? And then compare where you are now to what that normal year would look like. That gives the bank a very good idea in terms of where the problems are and what your business might look like coming out of COVID. There were certain industries that were struggling before COVID started. A good example of that is the retail industry. So if you're in an industry or your business was suffering beforehand, you're going to have to put a very strong case forward to be able to be for the bank to consider providing this facility to you. If you were in an industry, or are in an industry, sorry, that has been directly impacted by COVID, and a good example of that is the restaurants, cafes, and for a lot of you on this call, those in the hotel industry, then you are likely to qualify. But the only thing I'd say on that, if you were in those industries but you were struggling beforehand, again, you'd need to put up a very strong case to establish why or why you need these funds. So what do I need to be looking at in my business? So I'd encourage you to provide as much detail as you possibly can to demonstrate to your lender how you've been impacted by COVID. Some of the questions that the lenders might ask are some of your customers, are they simply unable to afford to pay you now, but are likely to pay you in the future? Or is it likely that you're going to be writing debts off as a result of COVID? Have you incurred some cash costs now that will mean your expenses later down the track are going to be less? So a good example of that is you may have incurred some cash costs now because you've had to lay some people off, but obviously later down the track your wages cost is going to be lower. Are there some expenses that you are automatically going to avoid because of COVID? So a lot of us are working from home at the moment, so your power costs may have gone down. Your fuel costs may have decreased. You may have had some casual employees that you were able to let go. So consider those costs that that may be less now as a result of what we're going through. Importantly, what terms have you negotiated with your suppliers? So hopefully you're working with your suppliers to keep them on board, and in particular those suppliers that are considered to be critical to your business. Are they on board now, and will they be on board afterwards? Or have you got some suppliers that are being particularly difficult? Again, let your bank know. It's much better they know than they don't know. And finally, have you negotiated a repayment plan with the ATO? I'd encourage you to look at this as an option, and again, speak to your bank about how that's impacting your business. You need to, at the end of the day, you need to be honest with yourself and honest with the bank, and give them as much relevant detail as you can to support your application. Another question the bank will ask is, what have you been doing in the last couple of months in respect of your business? So we've all, a lot of us have moved to working from home. What unnecessary expenditure, or what you deem unnecessary expenditure, have you eliminated in your business? So the obvious one is travel and entertainment. That's really been forced upon us in terms of the restrictions that are in place. But are there any internal projects that you had that you've put on hold? Any advertising and marketing, that's an obvious one, and training is another one. Have you got any repairs and maintenance that can be deferred until after we come out of this period of uncertainty? Is there anything specific that you've done to your business to change the way you've been operating over the last couple of months? A good example of this is some pubs in New South Wales that have opened their doors. They obviously can't trade as a pub, but they've used their premises to sell products that are very or urgently needed in the community. So some businesses have also moved online. A lot of the JB Hi-Fi, for example, their sales online sales have gone through the roof over the course of the last 4 to 6 weeks. Another question the bank will ask is, what savings do you have, and what other assets do you have that you might be able to sell to raise cash? Basically, at the end of the day, you need to demonstrate to the bank that you can back yourself so that they can back you. The big question, how much do you need? So the bank will really want to have a proper understanding as to how much funding you're going to need over the course of the next 6 months. And to do that, I'd encourage you to prepare a cash flow forecast. Now, this cash flow forecast does not need to be 100% accurate, and the banks will not expect it to be 100% accurate. We are, as a lot of commentators have said, living in very uncertain terms at the moment, so it would be completely unreasonable for a bank to ask you for a forecast that's going to be spot on. But it will give you, and it will give your bank, a really good idea as to what your cash flow is going to look like over the next 6 months. And it will also demonstrate to both you and your bank what you need that cash for. I would encourage you to speak with your accountant in terms of developing this cash flow forecast, and where you can, support the forecast with some assumptions. This doesn't need to be war and peace. It needs to be there to provide the bank with a very high-level overview as to what your business is going to look like over the next 6 months. And the important thing to recognise here that your bank will view this very, very positively in terms of your application. It demonstrates that you've got a proper understanding of your business and a proper understanding of the cash flow and how that's going to look over the next 6 months. Okay, I might just pause there. We're about halfway through the webinar, just to see if there are any questions that anyone might have. So I'll obviously use the Q&A at the bottom of the screen, but I might just open to Sam and Steve to see if any questions have come through that I should be answering now.
Hi, Bruce. Yeah, don't have a lot of questions so far, so I think based on that, we might proceed on and yeah, finalise with questions at the end.
Okay, thanks very much, Steve. So moving on from where I was at before, what will you be using the working capital for? And so a lot of these, this question can be answered from the cash flow forecast that you've prepared. But one question I would encourage you to ask yourself is, do I really need to incur this expense at this point in time? Is it something that you can defer to a bit later on? Because one thing you need to remember is whatever you borrow, you will need to be paying this back. And remember that the package that's provided by the bank is a support package to help you get through the impact of COVID-19. So I mentioned before, you do need to repay this back, this facility back. So firstly, I would encourage you to don't go for the whole 250 if you don't need the 250. That the amount that you need will be based on your cash flow forecast, and then I would build a little bit of headroom in there as well. So no one can predict when this is going to end, but we can make some assumptions. The government have basically, or the federal government have estimated that this may last another or go 6 months. And the reason why I say that is because the first 6 months of this package are interest only, and the interest is capitalised into the facility. So you don't have to make any repayments over the course of the first 6 months to September. After that, the facility is interest only for 6 months. So you just pay the interest on the loan or the amount that you've borrowed. It's important to note that this is not an interest-free product. You do have to pay interest, and you ultimately do have to pay the loan back. The facility will operate like a line of credit, so you will draw down the facility as and when you need it, and obviously when you get any cash in, that will reduce the amount. You'll only be charged interest on the balance outstanding, not on the facility limit. So let's now fast forward to October 2020. So let's say you've borrowed $250,000, the full amount that you can. That over the course of the last 6 months, so between now and October 2020, you would have incurred roughly $6,000 worth of interest if we were to assume an interest rate of around 5%. So your loan at the end of October is going to be, the end of September is going to be about $256,000. From October to 2020 to April 2021, you're going to have to start paying the interest on that $256,000. And that will be roughly $1,000 per month. The question you've got to ask is, will you be able to afford that $1,000 over that 6 month period? How will you make these payments? Where will the cash be coming from to make these payments? Very, very difficult question to ask and answer, but you have to give it your best shot. And as I said before, the bank will want to have a rough idea about this, but they're not going to hold you to it. I do believe the banks are going to be as flexible to deal with as they possibly can. So now let's forward to now. We're now at May 2021. So 12 months from now, you've had your 6 months of interest being capitalised on the facility. You've paid interest on the facility for the past 6 months. You now owe around about $262,000. Again, assuming a interest rate of about 11.5%. Sorry, 5%, not 11.5%. The amount that you would need to be paying back each month for the next 2 years is going to be roughly $11,000 per month. So the question again is, how will you be able to repay this back? From what source will you be getting this cash? Assuming we're back to some degree of normality, what will that look like for your business? Again, I stress these are difficult questions to answer at this point in time, but you need to demonstrate to the bank that you've given some thought as to how this facility will be repaid. So we've covered a fair bit over the course of the last 20 minutes in terms of this webinar. There's a few questions that some of these questions that I've posed in the webinar are going to be difficult to answer. However, with the assistance of your accountant, I believe that you should be able to do this. A good banker will understand and will undertake the assessment with this in the back of their mind, that you've addressed some key risks that your businesses are facing. You've addressed the key questions that you believe you would ask yourself if you were lending the money. And you do believe that you can actually repay this facility at the end. At the end of the day, the banks, they manage cash and they are the backbone of our economy, and they're very, very important over the course of the next 6 months and beyond in terms of us rebuilding the Australian economy after this virus. It's also important to note that banks need businesses like yourselves for them to stay in business, and businesses like yourselves need the banks. So again, I've said this before, I do believe they are there to support businesses, but we will need to demonstrate that we need the facility and that we can repay the facility. The more information you provide the bank, the more relevant information you provide the bank, and the timeliness of the provision of that information will help you enormously. If you can gather the information, put it together in one submission, which is how we do it for our clients here at Perks, that will give you a far better chance of getting a quicker response than if you drip feed the bank with information. You go in unprepared, you don't properly understand your business or your cash flows. These are things that are going to hamper or delay the decision that you might get from your bank. Whereas a well-prepared, well-thought-out application is going to get a far speedier response. As I mentioned before, one thing you can ask yourself as you're going through the process is, if you were lending yourself the money, what sort of questions would you be asking, and how would you like those questions to be answered? So before I move on to questions, I'd just like to put up the last slide, which provides you with some useful numbers and links. So over the course of the last 10 days, 2 weeks, a lot of you would have been grappling with the job seeker payment in terms of the wages that you've had to pay, and hopefully over the course of the next 5 to 7 days, you'll be starting to receive your first instalment back from the government. But this will create a working capital or a bridging need within your business, and this $250,000 facility is in part designed to assist with that bridging gap that you may have. So what I've done there is I've put up the hotlines for each of the banks. Each of the banks have set up a specific team within their businesses to deal with the bridging finance aspect. So this is different to the $250,000 unsecured loan that I've been talking about. This is to assist with bridging finance, which might form part of that $250,000 loan that you might apply for. The question you might be asking is that you've approached your bank. They're very, very busy. They're trying to help, but they're just not responding quickly enough. Sam mentioned before that at Perks, we do deal with the major banks. We deal with the second-tier banks. We also deal with a number of fintech lenders that Sam mentioned before. These fintech lenders, and we have a few on our panel, they provide very quick and easy access to working capital funding. They are slightly more expensive than the banks. However, the speed within which they respond and can provide the funding is absolutely fantastic. And I'll give you an example of a client I worked with last week to demonstrate how they work. So this is a client that's been in business for about 35 years. They needed some funding to assist them with the payment of their wages ahead of getting the job seeker repayment from the government. They were after $500,000 from their banks. They were speaking with two of the major banks, and I encouraged them to continue to do this, but by way of a backup plan, I also spoke to a number of fintech lenders for them. So at the end of the day, they did avail themselves of a $500,000 unsecured facility from the fintech lender. The cost of that funding over 6 months was going to be $40,000, which if you were to go to a bank, that might be $25,000, at 5%, $12,500 at 5%. So again, I mentioned before, it's a lot more expensive. But they got the funding. The application process started on Thursday. I spoke with the lender over the course of the weekend. The facility was approved on Monday and the funding was provided on Tuesday. So from Thursday when we started the process to Tuesday, the funds were in their account. That provided them with the comfort they had the money in there to pay their wages. That was the purpose of the facility, but it also meant that they've got that funding in place to pay for suppliers, any incidental costs that they've got to keep the business going over the course of the next 6 months. Again, a very, very speedy decision, very quick access to the funding, but you pay a little more for it. As someone said to me the other day, in some instances, the cost of not getting a loan is far greater than the risk margin applied from a non-bank source. So again, you pay a little bit more, but you have the comfort that you've got what you need. As I said, again, this is a good source of funding that can really help you through this process to get you out of a muddle if you're in a muddle, and an alternative to the banks if you are having a few problems with the banks. So on that note, I might finish that's the end of the webinar, but certainly here to answer any questions that you may have. So now I might go back to Steve and Sam to see if anything's come through the Q&A.
Yeah, thanks, Bruce. Had a couple of questions come through. So one from a lady who owns a couple of retail stores who only opened recently in November. I've got no historical data. Is that something that would be able to help?
So yes, that's an interesting situation because you've got nothing to compare to from last year. I would assume that as part of the process you went through to start the business, you would have prepared a business plan and some cash flow forecasts. I would encourage you to update those forecasts to demonstrate how your business is looking right now, what your business might look like once some of the restrictions are relaxed. And so we are hoping the government are going to come out with some announcements tomorrow, and in this state, hopefully a few more restrictions might be relaxed a lot sooner. So as part of your setting up business, I'm not sure if you did approach the bank, so it's certainly something I could take offline with this particular person and see if we can help them. But certainly I'd be approaching your bank, but go through all of those questions that I mentioned before and answer those to see how you've been impacted. But certainly, please give Steve or I a call afterwards and we can go through in a bit more detail with you.
Thanks, Bruce. And just following on from that, the experience has been that ANZ seems to be pushing overdraft facilities, right, and not real keen to entertain these $250,000 government-backed facility. Are you able to provide any comment on that?
As I mentioned right at the outset, there are a number of banks who have approached this slightly different to others. I prefer not to mention those banks, but some of them would prefer the overdraft facility simply because the payment terms on that might be different to the unsecured loan, and it might suit your circumstances better to have an overdraft facility rather than this particular facility that the government have offered or the government have provided backing for. I'd encourage you to go through or speak with your relationship manager at the bank to properly understand why they are recommending an overdraft as opposed to this facility, and explain to you why it is more beneficial for you to have an overdraft rather than this facility. And they should be doing that as part of the whole process. And if it comes down to a credit or a risk appetite within the particular bank, then I would expect them to explain that to you.
Thanks, Bruce. Might shoot over to Sam now. Sam, are there any things that you can be doing with the ATO as a source of short-term funding?
Yeah, absolutely. So I guess in normal times, accountants and also banks are keen to see clients not build up too much of a debt with the ATO. Generally, they're quite slow in chasing and recovering debts. And because of that reason, sometimes they end up being paid last. So yeah, in normal times, banks are really wary of that. But I guess at the moment, the ATO, given the current climate, have got a couple things to take advantage of to help from a cash perspective. So the first that we're dealing with a lot of our clients is any current or new tax debts for businesses that have been affected in any way by the shutdowns can be extended out to September the 14th, and we're hopeful that one, by then things will be on the way back towards normal, but two, also that the tax office will be willing to negotiate a new payment plan starting from that point. So they're happy to defer it out, and they're not charging interest. So that's effectively an interest-free loan, which we'd encourage you to take advantage of. And the second one's slightly more technical for any individuals or companies that pay tax by quarterly instalments. In normal times, if you vary those instalments down due to a change in trading conditions and you end up paying less than 85% of your eventual tax, you're penalised, and the ATO will impose penalties and interest. They've said at the moment that they won't be doing that for instalments during the 2020 financial year due to the economic uncertainty. So you can vary those instalments for March and June down to nil. And you can also, if you've paid instalments in September and December last year, you can actually vary down and get a credit for those. So we've had clients who have been paying tax as they go towards their 2020 tax liability actually get refunds of that tax they've paid back into their bank accounts to provide a bit of liquidity, and effectively that's another interest-free loan. It's not a tax break; it's just a deferral. Anything that's not paid now will need to be paid on lodgement of the 2020 tax return. But again, it provides that cash now, and that makes that an issue to deal with down the track. Effectively, an interest-free loan for 12 months.
Thanks, Sam.
Steve, can I just add? Again, with the ATO, it's important that if you enter into a repayment plan, that you explain why you've done that, for the reasons that Sam said before. You know, this is effectively an interest-free loan. It makes sense for you to do that because that helps manage your cash flow over the course of the next 6 to 12 months. So as part of the application process, I would encourage you to explain to the bank why you've done that.
Thanks, Bruce. Sam, also, what are some good examples of working capital funding?
Yeah, so good question, Steve. So working capital is a bit of an accounting term and a banking term that not everyone might really sort of be across exactly what that means. So your working capital is effectively the current assets and liabilities that you need to operate your business. So in normal times, working capital facilities are generally used to facilitate growth. You might need to invest in stock or in staff training that will need to get paid for before you can sell your good or service to repay your creditors. So obviously at the moment, not many businesses are growing. It's more going the other way where we're contracting. So if your creditors were equal to, or in some cases slightly more than your debtors, your cash and your stock, you might have found that you've either had to liquidate your stock, tip in money yourself to pay out those creditors, and you may have been able to do that, but now you're sitting in a point where you've got no cash flow, you have still got a few things that you're paying, and for you to reopen your business, you really need to be able to go and get some cash in to, put your money back in your float, make sure that all your major suppliers are paid, because quite often, I think they might be a bit worried at the moment, might be requiring cash on delivery of stock and other equipment. So where a working capital facility would really help would be getting that money in to allow you to pay for what you need to get your business back up and running, but knowing that as normal credit returns and your suppliers, provide you with credit of, 15, 30 days, you'll get back to that equilibrium where you've actually got a bit of funding from your creditors, and that is effectively how you would repay this working capital facility. So that's probably the best and simplest example of a good case to get one of these facilities. But the key is that you should be able to show really easily that over time you'll be able to replace this new bank debt with credit from your suppliers.
Yeah, thanks, Sam. Bruce, we just had another question come through just regarding the 250 limit. If client has a number of different companies that they operate under, can they have multiple facilities?
That's a common question that we're asked, Steve. A very good question. So the facility is available per borrower. So if you have a number of entities within your group, then on the face of it, each entity would be eligible if they meet that criteria I mentioned before about the turnover, etc. However, you need to demonstrate for each entity that that entity has been impacted by coronavirus. So the banks will look at this very, very closely to properly understand how the group is made up and how the cash flows of those particular entities have been impacted. I just want to go back as well to the working capital question before, Steve. Sam mentioned how accountants and banks look at the working capital position. During the webinar, I mentioned that it's important to have a proper understanding of your debtors and your creditors, and negotiating terms with both parties. Again, that's a good reason why you should be across that, because it forms part of that working capital calculation, and something the banks will be very keen to understand and expect you to be across.
Yeah, great. Thanks, Bruce. Just having a look through these. Oh, the only other one we had here was across the lenders, are all the terms of this facility the same or similar?
The criteria to qualify is the same. However, each lender will apply their own credit assessment parameters to the application. So as you would experience going through Bank A or Bank B in terms of some finance before COVID, some banks may have different credit risk appetites for particular industries, and for particular sectors within those industries. So the answer to that question is it will vary from lender to lender. However, I would encourage you to go to your current lender first for this particular package. Your current bank will understand and know your business better than any other bank that you've not dealt with before. If you go to another bank, the first question they will ask you is, have you gone to your current bank to see if your current bank will provide the facility? And if you've done that and your current bank has said no, it is highly unlikely that another bank will provide that facility. So for this particular facility that's on offer or available, I would encourage you to go to your current bank first.
Thanks, Bruce. Doesn't look like we've got any more questions at the moment, but we might just leave it open. If anybody's got any, oh, we've just got one come through. Bruce, should you approach your bank direct or come through via a broker? What would you suggest?
I would suggest, first of all, having a chat with your accountant and speak to them just to first of all establish how much you need and how long you need it for. If you've got a good relationship with your bank, I'd certainly encourage you to go and speak to your banker first. If you don't have a relationship or a dedicated banker, it might be worthwhile going through your accountant or your broker. I'll give you an example. Perks and a lot of brokers have got some very strong connections with specific bankers within the banks. And so we know the people to go to. We know the people who will turn things around quickly. And importantly, again, and this is Perks and other brokers around good quality brokers around town. We understand how the banks work. We understand what information they need, and we understand how they'd like it to be presented. And that can help get a speedier decision than if you deal with the bank directly yourself. So firstly, I'd say if you've got a very strong relationship with your bank and your bank really understand your business, go to them direct. But certainly if you're feeling a little bit uncomfortable or not sure, then I would certainly engage the services of your accountant and the broker.
Yeah, great. Thanks, Bruce. Doesn't look like we've got too many more questions, unless anybody's got any more last minute ones that they'd like to send through. No, I think that's about it, Bruce. So,
okay.
Do we have any more? No, I think Brilliant. If you'd like to wrap that up, Bruce.
Okay. Well, thank you very much, everyone, for your attendance today. I hope this webinar has been of some help to you in terms of how you manage your working capital and the services that are available and the products that are available from the banks. We recognise this is a very difficult time. We are all in this together. But remember, there are some very valuable resources available, and at Perks we've set up a dedicated COVID-19 hub, which can provide you with help not only with your banking and finance, but accounting and other areas that might be impacted by your business. For example, employees and dealing with your employees during these difficult times. If you would like to have an independent review of your business to determine whether you qualify or you would be successful in terms of getting this $250,000 unsecured loan from this government guaranteed by 50%, please come and speak to myself or Steve. We're more than happy to help you. We do have a package available which is within that COVID-19 hub that I mentioned before. We'll send some information about this session and the recording of it over to you by the end of tomorrow. But one thing I would ask, if you do have some time, please, is that we have a short 1-minute survey at the end. If you have got the time to complete that, that would be very helpful in terms of providing us with some feedback. But once again, thank you very much for your attendance today. I do hope it's been helpful. Please contact me or Steve directly if we can help answer any questions that you might have that you didn't post on the Q&A. But other than that, have a great day and see you soon. Bye.